Hey, welcome back to the What the Wealthy Do podcast, where we pull back the curtain on the tips and tricks and hacks that the strategies use to build their wealth and show you how you can employ those same strategies to your personal wealth building journey. I am your host, Stephanie Dorsey. I am the CEO and co-founder of Margins Capital. Margins Capital is an investment firm that provides women and people of color access to an institutional quality of alternative investments. Welcome to part 2 of our Stock Due Diligence Series. Last week we talked about the qualitative side, asking, does this make sense? Can they win? And we covered strategy, competitive advantages, leadership, and all the thinking that needs to happen before you look at the numbers of a given company. But today we're diving deep into the numbers themselves. Now I know some of y'all are like, I don't like it. Stephanie, I don't like it. I am not a numbers person. My eyes glaze over whenever they start talking about all these different ratios and whatnot. I get it. But I know you have the capacity to understand this. The problem is when we try to understand every single metric. Today we are focusing on the ones that absolutely matter first. Today I'm breaking down the top 5 essential metrics you need to evaluate any stock, what you need to understand, and that's it. Just 5. We're focusing on 5 today. We're not going to do all 20. Once you master these 5 numbers, then you'll know more than 90% of all retail investors. And then you add that to the qualitative assessment that I walked you through last week, then you're going to know more than 97% of all retail investors. Before we get into it, you know the drill. This podcast provides financial education and not financial advice, so let's go. All right. Most people get overwhelmed by the numbers because once you Google how to analyze stocks and then they're hit with hundreds of metrics. PE ratio, PB ratio, PS ratio, EPS, ROE, ROA, ROIC, debt to equity, all of these numbers, it's a lot. It's so much. It's so much. And it's a lot for me. I went to business school. It's still a lot. It's just crazy. It's really overwhelming. And so a lot of folks just give up. They're like, oh, I'm not doing this. And then they just buy stocks based on vibes. And then, or, what some finance bro said online, and it's just a mess. And we're not doing that. So here's what the wealthy and you now know. You don't need all of that. You just need to know a handful of metrics that matter most. And these are the ones that are going to give you a relatively complete picture of how the company is doing and whether or not they are worth your money to buy today. Right? Because that's important. And one way to think about this is when you go to the doctor for your annual medical checkup, or for a checkup anyway, the doctor is not going to run 100 tests on you every time you visit. They're going to check your blood pressure. They're going to check your heart rate. They're going to look at how much you weigh. They're going to check your temperature. Maybe they'll run a couple blood tests, but they're going to look at key indicators to tell them if you're healthy or if something else needs attention. And that same logic applies here to evaluating stocks. So today I'm just going to give you the 5 vital signs of a healthy company. And if these 5 numbers look good, the stock deserves deeper analysis, which you've already started because you looked at it qualitatively. And if multiple red flags show up, then you need to walk away. It's quite simple. It is. And that is all. And so let's get into it. Here are the 5 metrics that we're covering today. First, PE ratio. That means price to earnings ratio. And it answers the questions, am I overpaying for this stock? Is the stock price reasonable? The second equation is profit margin. Is this company actually making money? Is this company profitable? The third metric is revenue growth. Is the business growing or dying? Because that's really what it is. You're either growing or you're dying. The fourth metric is debt to equity ratio. Can this company pay their bills? Can they handle their debt obligations? And then the fifth and final metric that we're going to talk about is free cash flow. Is the profit real, or is it just accounting magic? Is it just on paper? Is the profit actually translating to cash? Because that's what matter. That's like, we all know rappers or millionaires or even like people who earn six figures and they're living paycheck to paycheck. And you don't want to invest in that. Like, they could be your friend, right? These companies, they're not your friends. We're not giving them money. We're not going to give them our money, right? So we're going to talk about that. All right. First one, let's talk about the PE ratio. So how you find that means price to earnings ratio, so that you divide the stock price by the earnings per share. And so this ratio is probably the most important valuation metric because it tells you how much you're paying for each dollar of the company's profit. And so let me break this down with an example. Say a company's stock is trading at $100 per share and they earned $5 per share last year. The PE ratio is 100 divided by 5, or 20. And that means investors are willing to pay $20 for every $1 of profit the company generates. And so what does this tell you? A low PE ratio, so anything under 15, this could mean that the stock is undervalued. That means it's a bargain, it's on sale. Or it could mean that the company is in trouble and investors don't expect it to grow. A high PE ratio, something over 30, could mean that investors expect high future growth for this company, or it could mean that the stock is overpriced and overhyped. The PE ratio alone doesn't tell you if the stock is good or bad. It just don't. It is just one data point. You need context. Here's how the wealthy use the PE ratio. You compare the current PE ratio to the company's historical PE ratio. So if a stock normally trades at a PE ratio of 25, but it's currently at 15, that might be a buying opportunity, especially if you're looking at a stock like Coca-Cola or Walmart, or something fundamental has changed. Right? And so the second thing you need to look at, so you look at historically what's happening, then you want to compare the current PE ratio to what the industry is doing. So you look at the industry average. So if this company that you're evaluating is a tech company, they often have PE ratios of around 30 to 40 because investors expect high growth. But the PE ratio of utility companies might be somewhere between 12 and 15 because they're stable, but they're slow growing. So a tech company with a PE ratio of 20, it might be cheap, versus a utility company with a PE ratio of 40 might be very overpriced. And so the third thing, you want to compare that stock's PE ratio to what the S&P 500 is doing. The S&P 500's average PE ratio is around 15 to 20 historically. And so if the market PE ratio is 25, we might be in a bubble. If it's 12, stocks might be on sale. So when I say it might be in a bubble, think about it like this. If on average the S&P 500 is 15 to 20, bubble means the prices are going up, but it's not sustainable, right? So if you're looking at the S&P 500 and the PE ratio for all those top 500 stocks on average is 25, it's like, can it keep going up? Or at some point, it's gonna come back down to the average, which is between 15 and 20. So that's what that means. The bottom line is, this was something that was difficult for me too, thinking about financial products the same way you would think about an actual physical product like a TV or a computer. They are a product, right? And so you want to make sure that you're not overpaying for a stock, right? You want to get the best value, right? Everyone loves a good sale. I mean, if you're a woman, I know you love a good sale, right? And so they want to pay less than what the thing is worth because it just makes you feel really good. And so that's why you need to think about stocks going on sale or not. And that's what the PE ratio tells you. Also, just note, a low PE ratio does not automatically mean buy. A high PE ratio does not automatically mean sell. It is just an indication that you need to understand like what's going on here. It is telling you something is happening and you need to peel back the layers of the onion a little bit more to understand what's happening. Just know that a PE ratio that's completely out of whack without any explanation and there's no context that you can't figure out why something is very, very high or very, very low, then that's a red flag. Let's look at the second metric that we need to evaluate, which is profit margins. Are they actually making money? A company can have $1 billion in revenue and still be losing money, i.e., OpenAI, right? That's why you need to look at profit margins. The profit margin will tell you how much of each dollar in revenue the company keeps as profit after paying all of their expenses. So the key margin to focus on is net profit margin. So the formula for net profit margin is net income. So that's going to be revenue minus all their expenses. That's your net income. And then you divide that by revenue. And let me give you an example. Say a company brought in $100 million in revenue last year, and after paying everything, they pay all of their cost of goods sold, salaries, rent, taxes, interest on debt, all the things they paid, they had $10 million left in profit. Their profit margin is $10 million divided by $100 million, or 10%. They have a 10% net profit margin. And that means for every dollar that they made, they got to keep 10 cents of it as profit. So what's a good profit margin? It really depends, unfortunately. It depends on the industry. Tech companies have 20 to 30% profit margins because they have higher profit margins, because once you build the software, it's cheaper to keep selling the same thing. They don't have to build it over and over again, as opposed to a grocery store that has much lower profit margins of 2 to 3%, and they make their money on volume. So a grocery store that has a 3% profit margin is doing just fine. A tech company with a 3% net profit margin, you should absolutely run away. And so profit margins matter because high margins mean the company is more efficient. They're not burning money to make money. They have pricing power. They can charge more. It costs to deliver the product or service. And so low or negative margins mean the company is struggling. They might be overspending or underpricing or in a hyper-competitive industry. So what you really want to check out for, a big red flag, is if a company's net profit margins are shrinking over time. And that means that they are becoming less efficient. That means their costs are rising faster than their revenue, and that is unsustainable. But expanding margins over time is a green flag. So if margins are growing, that means the company is becoming more efficient, more profitable, and that's a sign of a healthy, well-run business. So what you want to do is, when you look at a particular company's net profit margins, you want to compare those net profit margins to key competitors and see how they're doing. Also compare it to the industry that they're in to give you a sense of what is happening in that industry and how that particular company that you're evaluating is performing within their space. The third metric that we want to look at is revenue growth. Profit margins will tell you how efficient the company is or healthy the company is. Revenue is going to tell you if the business is expanding or contracting. Revenue growth is simple. Is the company making more money this year than they made last year? You want to look at year-over-year growth. You also want to look at quarter-over-quarter growth. And so, again, context matters here. High growth companies, startups in tech, are expected to have a 20 to 50% annual revenue growth. More mature companies like Coca-Cola or Procter & Gamble are expected to just have a 5 to 10% annual revenue growth. Declining companies will have a shrinking revenue growth or have a negative growth. And again, because we are longer term investors, we need to be making sure that we are investing in spaces that are expanding rather than spaces that are contracting. And a growing revenue means that customers are buying the product and there is a market for the product and it is expanding. One thing to remember is either you're growing or you are dying as a company. You need to always be growing, frankly. You need to be expanding your market share. You need to be bringing new products online. Once you get to the tippy top of the mountain, there's only one place to go. If you are running a company or you're investing in a company, you certainly don't want to invest in a company that's at the tippy top and they just going down. You want to invest in a company that's at the top of the mountain and they're figuring out a way to expand and they're finding another higher mountain to climb. That's where you want your money to be going because, girl, like, we work too hard. We work too hard. You earn good money, real good money, and yet you're still not entirely sure how to manage it and invest it. You've listened to the podcast, you've attended the webinars, and you've already started investing. And somehow, with all of that, you're still second guessing and afraid that you won't be able to create that 7 or 8 figure wealthy life of your dreams. The Sovereign Collective was built just for you. A judgment-free and safe space specifically for high-earning Black women who are ready to stop pretending that they have it all together and actually start building generational wealth. We are launching the founding cohort on April 14th. Just 20 seats. 20. Learn more at joinsovereign.co. And remember, you are always wealthy. All right. The fourth metric is the debt to equity ratio. And a company can be profitable and growing, but if they're drowning in debt, they are in trouble. Girl, we've all been there. We've all had debt that we felt very uncomfortable with at some point in our lives, right? And it's the same for a company. And so the way to calculate this is you look at their total debt, and this is going to be found in the P&L. It also will be on the balance sheet as well. And total debt divided by shareholder equity. And so say if a company has $50 million in debt and $100 million in shareholder equity, that means 50 million divided by 100 million is 0.5. And that means for every dollar of equity, they have 50 cents of debt, which is actually a healthy ratio. Carrying about 50% of debt on your books is actually healthy. You don't want to be over levered is what they call it, like have too much debt on the books. And so a good debt to equity ratio is anything under 1. The company isn't heavily leveraged. They have more equity than debt. That's generally safe. 1 to 2 is moderate. The company has a decent amount of debt, but it's manageable if the business is stable. If the debt to equity ratio is over 2, then they're high risk. And that means that company is carrying a lot of debt. And if revenue drops or if interest rates rise, they could be in very serious trouble. And so again, industry context matters. Some industries naturally carry more debt. Utilities, telecommunications companies, real estate. High debt is normal because they need a lot of capital to operate. So a debt to equity ratio of 1.5 to 2 in these particular industries might be fine. But tech companies, they usually have lower debt because they don't need as much capital to operate. So a debt to equity ratio of over 1 might be concerning for a tech company. And so this is why people are nervous about the AI bubble, and specifically tech companies that are using private credit like Meta to build these data centers, because the debt might not be showing up on their books. And even if it is showing up on their books, their debt to equity ratio are just much higher than what is typical for a tech company. So again, debt is not inherently bad. Companies can use debt to fund growth, acquisitions, capital projects, and the like, but too much debt is dangerous because they will have to make interest payments even if the business slows down. High debt limits flexibility and the ability to pivot or invest in new opportunities that might arise. So you got to definitely want to watch out for rising debt levels over time, because it could very well be signaling growth and investment in a given expansion area, but it could be a sign that they're struggling to generate cash internally, and that could be problematic. Okay, the fifth and final metric that I want you to pay attention to is free cash flow. Now, here's something most beginners don't understand. A company can show profit on paper and still run out of cash, it's very scary, right? And that's part of the reason why some people say free cash flow is the most important metric of all, because if you don't have cash to operate, then you can't pay your bills, you can't pay your staff, you can't pay your accounts payable, like you are done, right? So free cash flow is the cash that a company generates after paying for operations and capital expenditures like equipment, building, technology. The formula here is operating cash flow minus capital expenditures. And so say a company reports $10 million in net income. It looks great, right? So when you dig into the cash flow statement, you see they generated $15 million of operating cash flow. They spent $20 million on capital expenditures. So they bought new equipment, they expanded their facilities, whatever. 15 million minus 20 million is negative 5 million in free cash flow. So even though they were profitable on paper, they actually burned $5 million in cash. So why does this matter? Because cash is king. Cash is king. A company with strong free cash flow can pay dividends to shareholders. They can buy back their stock. They can pay down their debt. They can invest in growth opportunities. They can weather economic downturns. A company with negative free cash flow is burning through cash. And so they might have to raise more money by issuing new stock, which dilutes existing shareholder. They might have to take on more debt. They might have to cut spending, which could hurt growth. So negative cash flow for a fast-growing startup is a yellow flag. It is not a red flag. It is okay for a high-growth company to burn cash if they're investing heavily in growth and have a clear path to profitability. Think Amazon in the early 2000s. It is a red flag for a mature company. So if a mature, established company is burning cash, something is seriously wrong. They're either mismanaging operations or the business model is broken. So we like free cash flow because it tells you if the profit is real, right? So accounting rules can allow companies to show profit even if they haven't collected cash yet. Free cash flow cuts through that and shows you the actual cash that's being generated. All right, so where do you find these numbers? You do not need a Bloomberg terminal to do this. You can find these numbers for free on Yahoo Finance or Google Finance. You could type in the stock ticker, go to statistics, financials tab. Most of these metrics are right there. And you don't even have to calculate them, or at least they'll have the information there for you to calculate it really quickly. And then also you could go to the company's investor relations page on the company's website, and you'll find their quarterly earnings reports, which is the 10Q, or their annual reports, which is the 10K, with all the detailed financials. Also, your brokerage app, wherever you trade, most brokerage apps, Fidelity, Schwab, Robinhood, they provide key metrics in the app when you search for a particular stock. So I want to hit on these common mistakes, so make sure you do not just do this. One, I don't want you to rely on just one metric. A low PE ratio does not automatically mean it's a good buy. I also don't want you to ignore industry context. Like, don't compare a tech company's margins to a grocery store's margins. Like, it ain't even apples and oranges at this point. It is bacon and like bananas, right? And we don't want to do that. I also don't want you to focus only on past performance. Past performance does not predict future performance. So just because a stock went up 100% last year doesn't mean it will this year. So focus on current fundamentals, not past hype. Also, don't forget the qualitatives. Numbers can be manipulated. Always combine quantitative analysis with the qualitative analysis. Remember the questions from part 1 of the last episode. Does this strategy make sense? Can this company win? So you want to combine qualitative and quantitative. And then I also don't want you to panic when there is short-term volatility. If you do your homework and the fundamentals are solid, short-term price swings really won't matter. The wealthy think in terms of years, not days. Here's what I want you to take away from today's episode. You do not need to be a finance expert to invest like the wealthy do. You just need to understand 5 key metrics: PE ratio, net profit margin, revenue growth, debt to equity ratio, and free cash flow. That's it. Master these 5 and you'll know more than 90% of all retail investors. And when you combine these 5 quantitative metrics with the qualitative analysis from the last episode, you're going to know more than 97% of all retail investors, and you have a complete due diligence framework. Okay? Does this make sense? Can they win? Qualitative. Do the numbers prove it? Quantitative. If you can answer yes to all 3, you found a solid investment. So the wealthy don't skip steps, baby. They do the work. And I know y'all got this. And I know you can do this, girl. I know you can do this. I know you can do this. Do not listen to what they say about women not being quantitatively inclined or not being good investors. That is all cap. That is all. I know you have the capacity to learn all of this and crush it and do exactly what you want. And if that is invest, that is fine. If that is invest in individual stocks, that is great. If you don't want to invest in individual stocks, there are always index funds. So you are fine. Okay. All right. That is all for this episode. Thank you so much. If you found this to be helpful, please share it with a friend. Don't forget to like, follow, and subscribe wherever you get your podcasts. We are on Apple, Spotify, and YouTube. And I'll see you next week. Bye.